Recall that the auditor is required to gain an understanding of internal control during the risk assessment stage of the audit. And if they determine there's no great deficiencies in internal control, they could further rely on internal controls during the risk response stage of the audit. So basically, they can take a control approach to the audit down the road, meaning they're going to test controls, internal controls further, and use that in combination with test of account details to come up with the audit opinion. If they find that there are significant deficiencies in internal control during the stage where they're gaining the understanding, then they're not going to rely on controls at all during the risk response stage. So gaining this understanding of a company's internal controls is really key in helping us shape our audit plan and the audit program we're going to use down the road. So there's a couple of definitions here we need to be aware of when we're talking about issues with a company's internal control. The first one is deficiency in internal control. That refers to any deficiency basically where the design or operation of the control doesn't allow management to prevent, detect, or correct misstatements on a timely basis. So this can occur for two reasons. First off, there could just be no controls in place where they're needed, so that would be a deficiency. Or there could be controls in place, but they're inefficient. So we see here material weakness and significant deficiencies. These are kind of subcategories of deficiencies in internal control. Both a material weakness and a significant deficiency are a deficiency in internal control, but the difference is material weaknesses are bigger issues. So material weakness is a deficiency or combination of deficiencies that makes it likely there could be a reasonable possibility that there's a material misstatement in the entity's financial statements. A significant deficiency is a less severe form of deficiency than a material weakness. So it's not necessarily important enough to merit attention for those who are in charge of governance. If we do find a material weakness in internal control, we want to let the audit committee and higher levels in management know about that material weakness. So a unique situation arises when an auditor is dealing with a company that subcontracts some of their functions, some of their accounting functions out to a third party. So imagine a scenario where you're doing the audit of a client and your client does not produce their payroll internally. They go to a third party that actually processes the payroll, calculates how much needs to be paid, handles the payments, remits the proper taxes for withholding. So if this is the case, it's hard to make verification that this third-party servicer, they actually have good internal controls in place. So we want to think about this situation and we want to consider how an auditor might handle this type of scenario. So before we jump into talking about that in detail, a couple definitions we need to be aware of. We, as the auditor of our client, we're considered the user auditor. Our client is the user entity. All right, this is different from the service organization and service auditor. So in the prior example, our clients that we're auditing, they are going out and having their payroll subcontracted to a third party. That third party is the service organization, and any audits of their internal control are done by a service auditor. Notice we as the CPA for company XYZ, we're not going to go out and perform an audit of company XYZ's payroll provider. That's not within our purview. So we want to think about how do we handle that situation? How can we have confidence that the payroll is actually being processed correctly if we don't have access to information about the internal control of the payroll provider? So there's a couple objectives that we as the user auditor have when these services have been subcontracted. First one is we want to obtain an understanding of the nature and the significance of the service provided by this outside third party, and we want to know if we can have confidence that their work is good, and we want to be able to rely on that to gain an understanding of our company that we're auditing, their internal control. And also we want to be able to design and perform audit procedures responsive to any risks that we identify during this process. So sometimes our client can mitigate these risks. Sometimes our client can have their own internal controls in place overseeing the work of the third party. So imagine, again, we have this example where payroll is outsourced to another a company, a payroll processor, and they basically come up with the numbers. They figure out how much our employees are going to be paid for the period. They work through making the payments. So they're doing all this work. So they're doing this through their systems that we as the auditor do not have access to. But if our client is doing some work on their end to verify those numbers are correct, that can give us confidence that the risks are being minimized for our client. So for instance, our client could pick a sample of transactions. Maybe they pick so many payroll transactions each month and verify that they are actually calculated correctly by the payroll provider. So they might take information about an individual worker, how many hours they worked, calculate how much they were supposed to be paid, calculate how much tax was supposed to be withheld, and then match that against the records provided by the third party. So that's actually a check to make sure that the payroll provider is properly processing information on their end. So if this occurs and we have confidence that our client is doing a good job of making that internal control effort, that gives us more confidence that they have a high level of internal control operating in their company overall. Now we could see kind of this at play in the flow chart. Notice this first part is what we looked at earlier. So we as the user auditor can obtain this understanding of user entity controls if they have controls in place, all right, kind of double checking the work of this service organization. Now, that's one way that we can gain some confidence about the internal control over this payroll function in this particular example. Also, again, we're not going to audit the payroll processor, but we could rely on other auditors' work of oversight of that payroll provider's internal control. So there's these two reports, SOC 1 and SOC 2, reports that are basically by the service auditor. Remember, we're the user auditor. The service auditor is the CPA, the auditor that's overseeing the internal control in the payroll processor's company. So there's two different types of reports that they could produce, a type 1 report and a type 2 report. A type 2 report gives us greater confidence. It's a more detailed investigation of the service company's internal control, and it's going to talk about the operating effectiveness of the internal control of the payroll provider in this case. So the auditor, if they're relying on a type 1 SOC report, that's good information that can help them gain an understanding of our client's internal control indirectly by looking at what's going on with the service provider through the audit by another CPA firm of the service provider's work. But that SOC 1 report can't give us enough confidence to go out and test the controls. All right, so it helps us gain the understanding which is required during the risk assessment stage. But if that's the case, if we're relying on a SOC 1 report, we're not going to be able to do test of controls down the line. All right, so it's going to be a little bit more of a more time-consuming process for us as the auditor if we have to rely on the SOC 1 report. Now, notice a SOC 2 report that talks about the operating effectiveness of our third-party payroll processor. In this case, it's going to give us some additional information. So if we have a SOC 2 report, all right, it provides us with greater confidence that the payroll processor has good controls in place. And in this case, then we can actually do test of controls once we get to the risk response phase. So a couple of different ways, again, to handle a situation when there's a third-party processor. Our client can have internal controls in place where they're kind of overseeing the work of the company that is subcontracting the payroll for them. Or we can rely on reports by another auditor who oversaw the work of this third-party payroll processor. So on the audit, we need to take into account not only work done within the company, but if we have outside third-party entities doing work on behalf of the company, we need to take that work into account as well.